All right, welcome to the last part here. What this table shows is over here in this first column. It shows the different credit ratings from very safe AAA to already in default triple C down below here, and the I think it's Moody's slash S&P, something like that. And you notice how there are little pluses and minuses in here. So it's actually a little finer than just AAA, AA, single A. It's AAA, AA plus, AA. Anyway, so on. So it goes from some very safe bonds up here, safe credit rating, to the riskiest down below. And then across the top here, we have the time to maturity for the bond. And what this shows is like let's like take a look at let's take a look at this the triple B right here, okay, for 30 years. And if you go out to triple B 30 years, you see the number right here of 174. This is what that means. And give me a second here. Let me give me 1 second. It's a little harder to write in this program I'm using right now. All right, so let's imagine we have a triple B 30-year bond, okay? And what we want to do is estimate the yield to maturity for that bond. Because let's say we just have some bond, we can't get a quote for it. It's triple B, it's out 30 years. And so somehow, because remember, bonds, it's not like this New York Stock Exchange where you can always get quotes. So to get an estimate of the price, we have to first estimate the yield to maturity, right? We get a yield to maturity, then we can plug in the cash flows and figure out what the bond is worth. And for us right now, we can see that the yield spread equals what we say for triple B 30 years, 174, and that's basis points, okay? And it's over the 30-year Treasury bond yield to maturity. Okay? So that's what this table represents. And so what we need now is, let's assume the 30-year Treasury yield to maturity. Let's assume it's 4%. Okay. So what we do to estimate the yield to maturity on this triple B bond, we take the 30-year Treasury yield to maturity, and we add to it the triple B 30-year yield spread. So spread is just kind of shorthand for the amount of interest above and beyond the risk-free for 30 years. And for the 30-year time horizon, the risk-free is the 30-year Treasury. And so this table comes from, sampling the market of all these different bonds where maybe they could get prices, and they took the average for each maturity and each credit rating above the representative or corresponding Treasury. And now we can use this table, this kind of table of yield spreads, to estimate any bond, even if we can't get a quote for it. And so for us, let's just assume, I don't have this written up here, but we said it was going to be 4%, right? And so we take that 30-year. It's I'll just say 0.04, and then we add to it the 174 basis points. And so that in decimal form is 1 basis point. Okay, and so 174 in decimal form would be like this. And so our estimated yield to maturity for this triple B bond we have, 30 years, is going to be 0.0574. Okay? If we did this using 4%, right, instead of decimals, the spread would look like this. So it's just two ways of showing basis points, right? Okay, one is in decimal form, one is in percent form, just so you can get comfortable with how to use basis points and being able to talk with both. What this slide shows is how yields have changed over time, starting 1954 to about 15 years ago. And it shows it for different types of bonds. So the black line here is long-term treasury bond yields over time. Then we have the AAA, which are the safe ones, the BAA, which is like the bottom of the investment grade bonds, and then we have these junk bonds. Okay? And notice one, that the riskier bond, the higher the yield to maturity, right? The red is higher than the black because the red is a riskier bond. And then notice junk bonds, they didn't really start until the 80s. That was like the go-go 80s on Wall Street. That's around when the first Wall Street movie was. Companies wanted to start doing all these leveraged buyouts where they would like borrow lots of money and buy up companies and then like break them up and sell them off into pieces and fire lots of people and then go take your money and get a place in the Cayman Islands, so you don't have to pay taxes. So it was a pretty good deal for a while. They got a couple people though for trading on insider information because just running a business sometimes isn't profitable enough. They were also doing some insider trading based on doing these buyouts. And the junk bond, you look up Michael Milken, and you'll see a lot of story about this. He was considered the junk bond king. Anyhow, it only started in the 80s because before then, to say that someone was going to invest in risky loans, that's like loan sharking, right? That was just not in the investment world, but he was one credited with helping develop a market for people to buy these risky loans, and these loans were basically used to do a lot of leverage buyouts and stuff, and recapitalizations and management buyouts and all this kind of stuff. The other thing I want you to see is look at how the gray like jumps up at certain points. That's the high yield debt, and those were during recessions. And so that was like around 1990, 1991, 2000, the dot-com bust. And so what happens is when the economy goes into recession, people are worried about companies going bankrupt. And the companies that have the highest risk of going bankrupt are the ones with these really low credit ratings, or the junk bonds, right? And so the prices on these bonds go down because people don't want to be caught holding these bonds of companies that are about to go bankrupt. And if the prices go down, the yields go up. And that's what this chart shows. This chart is just shows an example of the term structure chart, or we call it the yield curve. And it shows the interest rate of treasuries over different maturities. Okay, so like down here is the 3-month treasury bill, right? Then you got 3-year, 5-year, 10-year, 30-year. Okay, and so that's just when people want to know what interest rates look like, this is the chart that they look at, because for example, short-term interest rates are down here, right? And obviously the chart for today is a little bit different. And then, the 10-year is often highly correlated with mortgage interest rates. And then the 3rd year is just like, super, super long term, right? And so that's how we communicate, treasury rates depending on the maturity. There's a couple of theories about the shape of this yield curve. And it turns out, sometimes it's like that, like what we just saw. This is called an upward sloping yield curve. But sometimes, depending on the economic environment, we'll have a downward sloping yield curve. We had a little bit of that over the last couple of years when short-term interest rates were really high, higher than long-term interest rates. And so a couple theories try to explain why are short-term interest rates higher, lower than long-term interest rates and the average over time, because people want to understand interest rates, because if you have to take out a loan, should you take out a short-term or a long-term? You get a better deal on one. And so this one, expectations theory, basically just says, well, if you look at long-term interest rates, we can actually chop those up into lots of little short-term interest rates. And so that makes it useful to do some mathematical calculations about future expectations. Like, okay, let's say I'm a company and I take out short-term debt all the time because it's the cheapest. And I take it out for a year, and then I just roll over the debt, meaning I take out new debt to pay off the old debt every year. I take out a 1-year loan, and that loan comes due, and then I take out another loan to pay off the old loan, and then I pay that for a year, and so on and so on and so on. And so people want to know, what are short-term interest rates going to be in 10 years? And so that's where the expectation theory comes into play. Liquidity preference theory basically argues that, in general, short-term bond interest rates are going to be lower than long-term because short-term bonds are less risky and easier to buy and sell. So they have less liquidity risk. If you need to buy some or sell some really quickly, you can do that with short-term bonds like T-bills, because they're only like for a year or 6 months or something like that, right? And so they carry less risk, and so they're in general going to be have lower interest rates. Long-term bonds, if interest rates change, we're going to see later when we get to Chapter 11, long-term bonds will change in price quite a bit. And so they have more risk when interest rates change. Long-term bonds, they're harder to buy and sell, and so they have this liquidity issue. And so in general, long-term bonds will have higher yields or higher future returns to compensate investors for this extra risk. And then there's something called market segmentation theory, aka preferred habitat theory. I don't know what it is, but when I hear preferred habitat, I just think of a hamster walking around, or they like to live, I don't know where, but this basically says that interest rate curve is subject to supply and demand and what investors want. What investors want, and then what companies that are selling bonds, what they're selling. So it's basically a function of supply and demand. And, we definitely see that because that's how the Fed operates, with supply and demand on these bonds. And we'll see that a little bit more when we get into later chapters. This last thing is a way to estimate future short-term interest rates, and we call that a forward rate. Like, let's say I roll over 1-year loans every year. Okay, I would like to look at that yield curve and use that market information to try and estimate what 1-year short-term interest rates will be in 10 years. Okay, so a couple definitions for us to get there. First off, the spot rate is just the yield to maturity on a zero coupon bond out to a given maturity. The 1-year spot rate, the 2-year spot rate, the 3-year, the 4-year, the 5-year spot rate, and so on. The short rate is the yield to maturity on just a 1-year bond. Okay, and I already said that the forward rate is a future a future short rate. I know they're starting to get a little confusing, right? So if I get a 1 year treasury bill or bond, whatever, for today, that's a short rate. But if in 10 years I want to buy another 1 year bond, right? I want to know what the short rate will be in 10 years. Well, today we call that the forward rate in 10 years. That's all it's saying. And so we have this formula here that combines all three of these into one formula and allows us to estimate what forward rates will be. Okay, and the point is, what are short-term interest rates going to be in the future? Because short-term interest rates are very important. So first off, this represents right here, the YN is the yield to maturity on a zero coupon bond out a certain number of years. Let's call it N. Okay, so that's this. Okay, out a certain number of years. So it's the zero coupon bond out a certain number of years, and you see we're multiplying it by 1 plus the yield to maturity of the return compounded for a certain number of years. So what this tells us is kind of like the compounded return that we would get if we buy a spot rate for a certain number of years. And all it's saying is, if we take another spot rate one less year into the future, and then multiply that by what we expect the forward rate to be out N years, the combined compounded returns of this should be the exact same as just getting a spot rate out. So like, for example, if this spot rate was for 10 years and we took the spot rate for 9 years and then compounded it, multiplied it by whatever the forward rate should be out in year 10, it should give us the same return, assuming investors are looking and judging returns for every single year appropriately. Okay? And that's all it's basically. So we can use these spot rates. We can get spot rate data in the markets, and then we can just estimate forward rates from that. Here's an example. If the yield on a 1 year treasury is 7%, and the yield on a 2 year treasury is 8%, what is the forward rate for year 2? So in this equation, this is 2 years, 8%. This is 1 year, 7%, and now we have to figure this forward rate out. And you know what? I'm gonna pull up the data here, the solution. I'm gonna copy it for y'all, and let me write it down here. Control V. And let me increase the size of that a little. Okay, so this is how you would solve that problem. So it's basically a little algebra. You plug in that 8% right here. That's for the 2 year. Here's the 7% for the 1 year. And then you have to solve for the forward rate in year 2, and so you get that 9%. Okay, I think that's it for this chapter, everybody. I'll talk to you later.